Welcome to the Dividend Talk podcast, episode 206, a snapshot of earnings from 6 European companies. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom, and I'm joined with my co-host, European DGI. If you want to learn more about us, please visit europeandgi.com, where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter, which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJ. Another week of earnings, this time all European. I can't wait for this one.
Yeah, really nice, right? I mean,
Yeah.
I like these shows the most because we get to talk about a few stocks that, not everyone in the world has easy access to, or that's not spoken a lot about. And I think that's this nice thing that we give with this podcast, right? I mean, there are many YouTube channels and everything talking about a dozen of American stocks, but I think this one of those episodes where we can really show the European flavors. So if you're from the States, please hold on. They earn a lot of money from the States, so don't worry, there's enough for you as well. But European stocks are also a little bit later typically with their earnings. Maybe they don't have the same financial system set up, maybe not so efficient. Yeah, that might also be true. But yeah, very interesting today. But I mean, it's a nice question to warm up, Derek, but have you seen this flash crash on Monday? Have you seen?
I heard, and funnily enough, I was told about it in work straight away. Someone rang me and said, "Are you okay, Derek?" I'm like, because they know about the podcast, they know what I do, and they're like, "You okay?" I was like, "Yeah, I'm fine. How are you? Like, have you seen the stock market?" So it's so funny like that. So my work colleagues then they're ringing me, telling me that it just dropped out of nowhere. But I don't know. I checked my portfolio today, and I have an email set up with IBRK. You can set a limit that when it reaches it, it tells you whether you drop or you exceed a certain amount. And the last 2 days, yeah, yesterday and today, I've got that email. So it rebounded pretty hard for me. I did quite well actually. So, but Monday recession. I know that on recession fears, I believe.
Yeah, I mean, it's so funny, right? And I was on Monday. I was working, and then sometimes you check what's going on, and I saw the stock market, and I felt like, whoa, the semiconductors 10% down, and then I continue with my work. In the afternoon, I log in, I see like, in the plus. I felt like, what the hell is happening here? And of course there was a lot on social media about the panic, and I felt like, no, in the afternoon, no, it's the crash is over. Let's move on.
Yeah. But I feel I've grown as an investor from where, because if this happened 6-7 years ago, I think a little bit of me would have been, if I got that call in work, I wouldn't have been able to concentrate. I would have been just, oh my God, and checking the market.
Yeah.
I didn't even bat an eyelid. I didn't care. It did not matter to me.
Me neither. I was rather thinking like, should I buy something or not? Yeah. Do I have time this evening to do some homework to see if I want to buy something else than I usually was intending to do under normal circumstances? But by that time it didn't matter already anymore. And if you zoom out on the chart, then it's not even a sneeze from a stock chart point of view. So yeah, it was funny. I mean, for me, those days are really exciting. Yeah, because you see the fear in the market, you see social media exploding, you see people losing their minds. But then I tuned into our community, and it's kind of peaceful excitement. What are you buying? It's so nice to be in our dividend community, and of course, specifically on Facebook, in the Facebook group there. It just, come on. If you're already a bit emotional on that side, then join the community, and they are there to calm you down because the posts are really nice.
Yeah, it's more of a meditating Monday for us rather than panic.
Well, popcorn. I would even call popcorn. Like for me, it's entertaining to see it, and because it's often the people that are on the way up, they are like a stock market genius, and on the way down, they become suddenly an economist, right? And start talking about macro and everything. And you and I have been very clear on this. We don't understand macro necessarily the best because, yeah, I mean, I know it from an educational point of view, I understand the basics, but I don't study it. I don't go in depth into it because it doesn't add value to my investment philosophy. Yeah? My investment philosophy is that it's a market of stocks, not a stock market. Yeah, and it goes down sometimes with the overall market, but for me, most important is the dividend at risk.
Yeah.
Yeah, and
Yeah.
just because the share price goes down in the market doesn't mean that my dividend is at risk. And our portfolios are like that. That if, for instance, I give you an example, there's a recession coming up, Ahold will benefit because more people will eat from home. Yeah, so it's really easy to sleep at night.
Very, very easy. But hey, not if you are Pat Gelsinger, because I'm wondering, as a shareholder, are you part of this consortium that are suing or threatening to sue Intel after they cut their dividend? I think
No,
I
no, no,
think
no.
shareholders are they are claiming to be caught blindsided, that they are accusing executives like Mr. Pat of misleading investors. And there's a lawsuit of around 32 billion in value against their name. In what in what world do you think you can do this? I mean,
Well,
I find this
eh,
crazy.
well, they have a point to some extent. Have you seen the video from Sven Carlin this week about Intel?
No.
So he went back to when Pat Gelsinger came in, yeah, as a manager, and he pulled up the slides from Strategic Day or something like that at the time, and they were promising slow growth and then really expanded growth after that, like really a 200 billion company, and then he showed like reality 2 years or 2.5 years later. Nothing came through of it, and then he showed a few more of those slides of the empty promises all the time, and just the hit and miss all the time with the delivery of it. So yeah, I recommend everyone to look up Sven Carlin's video on about Intel, because he really nicely puts it in perspective. And he quotes several times Warren Buffett saying, like, you shouldn't listen to what they say, but look at what they do. And he
Yes.
gives I think he said around Pat Gelsinger where you really need to
Yeah.
look at
Yeah.
that. Yeah.
Because Pat came in as a smooth talker. I think we all were. I mean,
Well, he's an engineer, so it resonates with us because we love
yeah.
people that know their shit. Yeah.
But he came in off the back of a good run with VMware. He had
Yeah.
pedigree. He worked with Intel. He knew the products, and I think a lot of people believed him, including me. I would say,
Myself as well.
even though I sold, I was still caught with the Pat Gelsinger kind of. I don't know. He had that.
Hype. Yeah.
He had all that hype around him. So it's been a learning for me. That's been a good learning, and I think I've learned that with Unilever. I think I have the same
Yeah.
kind of feeling with your man Hein Schumacher.
Schumacher.
I get a good kind of vibe off him, but the difference I see so far is that he's starting to implement, and you can see it. But I'm
He's
not.
delivering already a bit. I think the challenge from Pat Gelsinger is also much more different.
Yeah, of
I
course.
think Bob Swan, who we really disliked for everything he did, he was damaging the company already for many years with share buybacks and all this kinds of stuff. Yeah, and not focusing on the technology. And AMD and such, they were in the labs at the time innovating the hell out of it, and Intel was just like partying, yeah, with the shareholders. And yeah, now they have such a technological I said advantage, AMD and Nvidia, that it's really hard for Intel to keep up, because the others, they have the flywheel running, right? Yeah, so I haven't sold yet. It was always a small position. Still need to think about what I do. I want to look a little bit better at their roadmap and see what I can actually still believe from that.
It boils down to opportunity cost, which
Well, my investment thesis, I looked at it, right? My investment thesis has always been once those ASML machines come up and running and they can run volumes, they should have an opportunity to get back again. So that's what I need to look at. Is this investment thesis still standing for me? Because then it's for me now like something, okay, maybe we're just seeing here the worst possible quarter. Yeah. But that's what I need to evaluate. And yeah, if it doesn't match my thesis anymore, I just sell it. Yeah, and then okay, that's it. Yeah, you win some, you lose some.
Yeah.
I have learned that I need less turnarounds in my portfolio,
Uh,
and we have been discussing that in podcasts. I think Intel is my last one with Intel. I think probably the last one. So then I'm done with turnarounds. But hey, Meta did me really well. Yeah,
Yeah.
Meta. I think I bought it in the 70 and I sold it 500. So I more than doubled my money. Well, you cannot more than double lose your money on a stock. Yeah, only 100%. So
yeah. Look, if you're looking for another turnaround, there's always Walgreens.
yeah, or Medical Properties Trust.
Speaking of companies like that, let's look at recent dividend announcements. There's been a couple this week. We recorded on Sunday, so there hasn't been too many since then. But one company that I've spoke about before is Cogent Communications. CCOI is the ticker. The dividend raise is 1%, but bear in mind that these guys raise their dividend every single quarter. So 1% every quarter would be 4% a year. So it's not as bad as it looks on paper. Simon Property Group raised their dividend by 2.5% to $2.05. And Ahold increased their interim dividend from 49 cent, that is, to a whopping 50 euro cent, which is probably a little bit disappointing based on past performances. But I think it's a good intro into our earnings, and Ahold is up first.
Yeah, and let me be clear. I was hoping for 52 cents per share. But if you look at the dividend history, they sometimes even declined 1 or 2 times the interim, because what I understand, they're like paying out 40% of last year. I don't know if it's earnings or dividends, but something like that. So must be earnings or so. So that's okay. Yeah, the question is what will be the final dividend in the end. So that's more what I'm looking forward to. Generally speaking, actually, the Ahold dividends, initially I thought it was a mixed bag when I read it, but I went a bit deeper into it, and I actually appreciate the earnings a little bit more than before, because what I overlooked was how much the margins improved. And that's quite good, because Ahold was struggling all the time a little bit with that. But the margins went really nicely up. They have now operating margin underlying of 4.2%. And specifically, if we look at Europe, this was a really strong increase. Also, the earnings per share, as a result, IFRS related, went up by 10% to 53 cents per share. And what they call the diluted underlying EPS grew by 4.5% to 65 cents per share. Well, their free cash flow was quite disappointing, but here I must say that this has to do with the income tax that they had to pay based also on the Belgium tax receivable. And remember what we were complaining about this Belgium last year, right? That they were masking their positive free cash flow or like that according to their target, but there was just a large how is it called, kind of a windfall in there from Belgium, and now you see it the other way around. So I mean, the CEO didn't get away with it last time. That's where the share decline was at the time. He got punished for it. So and now he needs to make up for it. So that's really what we're seeing here. Also, their working capital what was a bit impacting. So all in all, just quite good. What I specifically like is that we're now already 1 year in a row, 4 quarters in a row, where Europe is carrying the growth for Ahold, not the United States. United States is actually kind of flattish, let's say.
Yeah.
So when we talk about comparable sales growth, but what we see in more reports from other companies, that Europe is actually doing quite well in relation to that, at least when it comes to the bottom line numbers. So things that helped Ahold in Europe is, for instance, more and more people are buying their home branded products. So shifting a little bit away from, let's say, the products produced by Unilever and Nestle and such, and building their house brands, buying their house brand, and those house brands, they have much better margin. Yeah, so I guess that demonstrates the cost-conscious consumer, but Ahold actually benefits from these kinds of things. So also online sales were up, so that was also good to see. Yeah, so actually not too bad, I would say. I'm quite positively surprised. So I understand why the market puts it higher. They continue with their 1 billion share buyback program. They did put a footnote like that the environment is a bit more challenging. So effectively, they're giving themselves some space to stop the buyback whenever they need to, if it gets bad. Maybe someone was writing the slide deck on the Monday. Yeah. Who knows? Yeah, but the free cash flow around 2.3 billion, right? And if you then have a dividend around 1 billion, then it continues to be a really sleep well at night stock.
Yeah, they're well on track for their outlook for 2024. They have that same disclaimer for the dividend as they do for the buyback, which is quite interesting.
Yeah, but I think they're more attached to the dividend than the buyback, so I feel quite comfortable there.
Yeah, they do mention their outlook is year-on-year growth for 2024. So
yeah,
let's hope they stick to that.
Yeah. So happy shareholder, share price went up. That's always a pity, because I'm trying always for Ahold to buy some shares for the dividends again. So I hope I can't buy less.
Yeah, I haven't looked at the share price. Is it trading 27, 28 euro?
30 or something like that now.
Oh, wow. Oh yeah, I haven't looked at it in quite a while, but yeah.
Well, now it's your turn then. Let's talk a bit about Siemens, because Siemens is also very interesting. And the main question we got from Anders Stargard is like, what's your take on the earnings? And is the company now a buy after the current dip?
Yeah, so I was looking at it, and I saw the dip. I saw the dip today when I was looking. I was quite interested, and then you look at the main figures, and you see, okay, you see revenue was down. No, revenue was up 5%, but you see orders is down 15%. But a lot of that is down to the mobility market or segment. And I don't know if you remember last year, but this time last year, they had a huge orders in the mobility. So they had, I think it was in Egypt, there was a huge train system that was going in there, and there was something similar in Germany. Maybe I have it the other way around, but there was two big orders. There was about 4 or 5 billion in orders just from them two countries. So they were coming from a really high base. If you take that out of it and just leave that flat or moderate growth, they've actually done quite good actually. As I said, revenue is still up even on the back of that mobility being down. The backlog remains high. It's still at 113 billion. That's quite a hefty backlog of orders that you have to fulfill. So that's pretty much guaranteed revenue over the next couple of years. And net income was up 2.1 billion. Overall, I would say it's quite solid. Like it's not the most exciting in the world. Quite solid, but I think mobility took a little bit of the shine off it because it was down 71% overall. But I think it was quite good. Free cash flow was also down, like also with working capital and some tax impairment as well. It was down 28%. No mention of the dividend for next year and increases or decreases. Just a kind of a sales update. But I would say for a half-year report, I'd be quite happy with Siemens at the moment. The dip for me, they did not drop hard enough. I still have them priced at around maybe closer to 150. I might get a little bit more interested. I think I want them at a 3% dividend yield. But solid as always from Siemens. Look, you know what you get. They cover that whole market, don't they? The digital industries, infrastructure, Healthineers, that whole industry. And when one falls, one normally picks it back up. So quite strong. Digital industries was up 19%, for example, and Smart Industry was up 12%. So still strong numbers from them.
Yeah, I mean, Siemens, it's this typical cyclical stock. So I'm just waiting for more like this stuff to buy in the recessions. Not today, not now. What was good to see was that the backlog, the new backlog is kind of similar as their sales in this quarter. But the sales last year was like 23 billion, now 19 billion. So it's kind of keeping the burn down of the backlog at the same level. It didn't necessarily decline a lot. So that was also good to see. Of course, what will happen in a recession is that some customers will pull back their orders. Yeah. So there's a risk associated to that. But other than that, underlying it seems to look really healthy, I would say.
Yeah, I would agree. Quality company. I'm at the. Oh, you know what? I always wish that I loaded up the truck when they were under €90. I won't forget it. I was talking about it, but I didn't have the conviction to buy at the time. But looking back, I should have. So
I'm looking now at my portfolio and I see that my cost price is €94 for the holding that I have.
Nice.
But also, like you, it can be a bigger position in my portfolio.
Yeah. I'll stick in that kind of area and move to Schneider Electric. They operate in similar worlds. Siemens are bigger, so they operate in more worlds, but Schneider operates in, say, the digital industries as well. What's interesting with Schneider is I looked at them quite recently and I did a deep dive in our newsletter, so I won't explain everything that I wrote, but what I will say is that they are pretty much investing into the future and backing themselves on these mega trends in digitalization, AI, and energy. So that's their main thesis. And I have to say that I'm quite impressed with it. I think they've done a lot of groundwork over the last few years to prepare themselves for the future. So if I was to classify Schneider, I would say that they are definitely a company to own now for the future. I think in the next 10 years, they're well positioned for that. Looking on their numbers, and it's pretty much as expected as it has been over the last couple of quarters. They were up 7% over the whole group. Energy management was up 10%. Industrial automation was down. I was surprised that was down. They said there's some softness in the discrete markets. But then you look at North America and the rest of the world, they have double-digit growth across both segments as well. So it's been quite a good quarter, quite strong for them. Adjusted net income was up to 2.2 billion, up 10%. This is an important number for them because this is what their dividend policy is set on. It's not set on cash flow. It's not set on net income. It's set on adjusted net income, and their dividend policy is 50% of adjusted net income. So if that increases 10%, I'm expecting a 10% dividend increase as well. So we'll see how it is over the year, but it's good to see that number quite high. Operating cash flow was up 15%. Again, they had some advantages with tax as well that came in and some windfalls. But I would say it's been a strong quarter for them, really on track. I think this energy transition, I think AI is really strong at the moment. And not just the hype, not just the chat GPTs, like they're using it in industry. And I think it's quite powerful in industry. And obviously digitalization is happening as well. I don't know, but where I work, there's budgets set aside for this. It's coming more and more. We're actually having more meetings on AI and digitalization. So I'm expecting this to grow actually quite quick over the next 5 to 10 years. But yeah, quite happy. Funnily enough, I did my fair value estimation of them. They were trading closer to 200, 180 when I was reviewing them. My fair value was set to 159. They are now trading at 159. So they're getting interesting for me. They're getting interesting. So I might when I get back from my Las Vegas, if I have any money left over, if I haven't gambled the house away, I think I might open a position in Snowden.
Nice. It's about time because you've been looking for a long time at this one.
Yeah, I have. It's always one that I looked on the surface. I didn't dig deep enough into them, and then when I dug deep enough into them, I liked what they did. They set the foundations, and they're looking forward. And I think they will have a big 5 to 10 years. So
Glad that you did, because I was pushing you often for like, look at Schneider, like you will like it as an engineer.
yeah, of course, of course. But it was right in front of me, and you had to give me the push. But yeah, I actually do really like the company. And yeah, happy with those results, and happy it's in my fair
Yeah.
value range as well.
Okay, then maybe let's stay a little bit in this area, because I have been looking at Spirax Group, formerly known as Spirax Engineering, British company. It's a global leader in thermal energy and fluid technology solutions. I assume you know more than me what this means. But it's a company that really focuses on this, like increasing the safety and such for these industrial processes. So what is really interesting about this company, I think it is trading around the 3 of maybe even towards a 4 or 5 years low. And Spirax Engineering has always intrigued me, because I discovered it as part of the Noble 30 index. It has always been on there and always full in the sky, that I thought, like, which idiot is buying these shares at that price? So now they are trading at 79 pound, yeah, which it hasn't been trading for a very long time. So, which makes this really, really interesting now to go to the earnings report, because they declined 8% in price today. So they already more than halved the price, I think. So what's happening here? First of all, if you look at their statutory earnings, then revenue declined by 3%, operating profit up by 11%, and basic earnings per share up by 10%. If you look at their own adjusted numbers, everything is in the red. Yeah, adjusted basic earnings per share is 12% down, revenue also 3% down, but adjusting operating profit 7% down. Everything is down. So if there's one good thing to mention here, is they increased the dividend from 46 pence to 47.5 pence, which means that they're also breaking their rhythm, because they were growing the dividend by 9 to 10% annually over the last God knows for how long. So it's clear that this company is going through a tougher time. They're blaming weak macroeconomic environments in key markets. So, clearly this business is being impacted, and it's in the industrial space. So it may be that they are one of those companies that is typically early on in the recessions, right? Because if consumer demand is weakening, they're the first one that will notice it with the orders, and therefore for their products. They're also claiming material currency headwinds, 4%, and also a 6% of that on the adjusting operating profit impact. So, it doesn't look so good, and it shows the cyclicality of this business, specifically the steam thermal solutions business unit was declining by about 6%. The other one, the electric thermal solution, was still up, and the Watson Marlow business unit was flat. If you then look at also the adjusted cash from operations, as how they call it, it was only a 3% increase, pretty much in line with their interim dividend increase. So they have reduced some debt, so they have been doing that well. Now, if you then look at it here, like let's zoom in into those business units, right? Just the steam thermal solutions, 20% drop in China. Yeah, so you can clearly see where it's coming from. This means that their products, as I understand it, are used there in the industrial processes.
Yes.
That means there is something happening in China there, that they need less of their products. Yeah, so maybe really that some factories are really like not operating on full capacity now in China. So I'm curious what that means for other companies that are a little bit more later in the cycle. Yeah. And because remember what we had with COVID, with Kimberly Clark, and the when we saw inflation coming in the paper, was kind of the first thing. I have this feeling here when I'm going a bit to the Spirax earnings,
Yeah.
that you can see, like, okay, we may be talking a bit here about a bigger problem. No wonder that on Monday there was a bit of a scare. It may actually already be in progress, but we'll just notice it a few quarters later in all the earnings. Yeah, which means also if you look at that, for instance, electrical thermal solutions also impacted again by the semiconductor industry, but they expect a recovery in demand later this year. Let's see. Yeah, we want to see the data of that first. Having said that, their full year outlook is low single digit organic growth for the steam thermal solution, for the rest mid single digits. So they do also in the steam thermal solutions business expect lower margins than in 2023. And this business unit is half of the revenue. So half of the revenue, and also let's say more than half. Well, let's say half of the earnings. Yeah, actually a bit more of the half. So it's the most profitable business, which is struggling specifically due to demand in China. So, having said that, Spirax, I think correctly lost its mojo and is trading now at a much lower price point. It's still a 1.8% dividend yield, so still on the low end. I think there may be more opportunity still for it to decline. But it's the first time actually that I found it worth looking into the numbers, because I'm not going to look into the numbers really of a stock that is, I don't know, trading at an 80 multiple for a simple, boring business. Yeah.
Yeah. It's definitely quite interesting to see that, because Spirax is a company I've never looked at because they've traded so high. I'm aware of some of their products, Watson Marlowe pumps, for example. I know in the ETS, the electric thermal solutions, they have some heat exchangers and boilers and stuff like that. So I've worked with them. The steam thermal solutions, I'm not so familiar with, I have to admit. And seeing that is their biggest, say, revenue drivers, the biggest market, it's something that I would need to understand before investing them. But I think this is quite interesting. We've seen a weak consumer in China. We talked about brands, but this is not a consumer. Consumers are not going out buying these types of products. This is industries. This is actually businesses over there. So now we're seeing a weak consumer and weak industry in China, and I find that really fascinating, I have to say. And what that means, I don't know. But it's definitely something, as you said, to keep an eye on.
Well, what it means is, like, you must then ask your question: is there suddenly a competitor in China that takes all their business, or is just manufacturing weakening there? And is this because there are less orders being placed for certain products that is being manufactured there, right? So, and what does that mean then? So this is the interesting thing that we are starting to see now in some of the earnings reports.
Yeah. And what did they say operationally? The team, let me check. The China team is pivoting to focus on process optimization and MRO. So they're cutting costs, basically. And
then they're in shit.
Yeah, and sector focus continues to drive good growth land. Yeah, so basically they're looking to cut costs. So maybe there's something else happening in China that we're not aware of. That doesn't point to me that it's competitor based.
Yeah.
But it definitely looks like that there's a lot of pressure.
I think I may put the webcast on as a audio cast, as a podcast or something like that tomorrow to just listen to what the CEO comments are.
Yeah.
We look at it now at the surface here, but I think it's nice to go a bit deeper into this one, because this company has always intrigued me from the Noble 30 index, always.
Yeah, and they've rewarded investors with special dividends when they do really well. 30 years of dividend growth, so it's not to be overlooked, I would say. I think it's an example of one company you need to have your homework done in case it does go a little bit lower. If that crashes lower, you need to have your homework done and have that conviction, because the past is quite impressive. So I think I'm actually, I think I want to look into this. I spoke to you off air. It's one I would be interested in, basically because I know some of their products, and I'm interested to see what technologies they have in this Steam one as well. So yeah, leave that with me. I'll do a deep dive, but looking forward to it.
Good. Yeah, and then still one company that I really wanted to call out, because I think many people have it in their portfolios, and I'm also really happy with my holding here. is good old insurance company Allianz. So we still have to get an N Group and ASR, if I'm correct. But yeah, Allianz is just continuing to grow. I mean, how much insurance can you sell? Unbelievable, right? So the total business volume went 7.6% up again to 42.6 billion. Mostly driven by the property and casualty business unit that grew from 17.6 to 19.3 billion in a single quarter compared to last year, which is up almost 10%. But also people are seemingly buying life insurance again, much more. So this business grew from 20.3 to 21.5. So that's kind of an improvement of 6%. And with those two, you effectively have their whole businesses because asset management is just 2 billion. Yeah. So what is interesting here in the property casualty business, the earnings declined a little bit. The profit it went from kind of flat, but it dropped 3.4%. With all that's been going on in the world and all those disasters, makes a bit sense. But then life and health insurance, it went 14%, almost 15% up in profits. So they have earned in the single quarter 6.15 euro per share. And for the first 6 months, 12.57 euro per share, which is very interesting if the dividend is 11.5. So thank you, management from Allianz. You have already covered the dividend from last year that you just paid out. So the rest is now all for the balance sheet in the upcoming 2 quarters, which is really good for us as shareholders. They paid the dividend, which is a really nice one. And now they can strengthen the balance sheet. They did agree to, because they already bought back 1 billion in shares this year, so they will do another 500 million. They can easily afford that as well. Their solvency ratio is at 206%. Such companies typically want to keep it above 150 to 170. So really a sleep well at night stock. Very happy shareholder. And they just did it again this quarter.
Yeah. The fact they have their dividends covered already for the years is quite impressive. I mentioned to you off air, for me, this is a company you should have bought 4 years ago. You responded with, I did. But yeah, I think it's performed really well. I would imagine Munich RE has quite a similar quarter, I would say. I haven't looked, but yeah, Allianz is a good company. But I'm not buying insurance or Allianz at these levels. I think it's a little bit out of my value range. But yeah, 4 years ago, the Messiah did it again. But I think I'm expecting something similar from NN Group and ASR, I have to say. I seen an article this morning just pop up saying insurance companies are posting strong profits in Europe. So I'm expecting more of the same.
Yeah, what's really interesting, this company at the moment pays still a 5.5% dividend. Yeah, so they are buying these shares back, 500 million here, 1.5 billion in total, and as such. So this is all very, very interesting. Yeah, it's very interesting that it is relatively low valued from a multiple point of view. Yeah, if you earn on a year like 25 euros or something like that, and you trade for 250 euro, that's like a 10 PE. We know that insurance companies don't trade at 20 PE necessarily. 10 PE and then buying back shares plus a fat dividend. Quite a nice investment case, yeah.
Nice one. I'll finish up on one more company quickly before we go on to the listeners' questions. And as it's Olympic season, we're all feeling patriotic. We're all following our own countries. But CRH PLC recorded their results. Quite a weak quarter, I would say. Europe has been disappointing. I think overall they had a 1% decline in revenue, but actually America helped prop that up. In Europe, they've been down in all markets in Europe, and they're blaming bad weather and some of the divestitures. And I don't know if the weather was that bad in Europe all the time. It's not Ireland, it's Europe we're talking about, but look, that's what they said. Bad weather has impacted them. A key part of their investment case and their growth is around their M&A activities. They're quite heavy in acquisitions. Again, this is no different this quarter. They've acquired a majority stake in Ab Abdri, I think they're called, which I'm not familiar with. But they've also been buying a portfolio of companies in Texas, in the materials business as well, which they are growing. So, I have to say they do quite well with their M&A business. So I would have to look into that company to see what they're like. But I have no doubt that they're a decent company. But look, revenue's down, net income grew by 8%. And they based that on cost control and operational efficiencies, so they're cutting costs. And yeah, they had a 5% dividend hike as well. I, they've moved to like the American Stock Exchange. They're committed to their dividend, so I'm expecting them to have that same commitment to the dividend because it's a lot of their. When you look at their investor relations and why invested them, they do mention that quite a bit. So I think that's going to be quite important to them going forward. And the 5% raise is not bad, I would say. The yield, though, at the moment is quite low. Before they moved to the New York Stock Exchange, you would have got around a 3%, even nearly 4% yield. It's now 1 point something, 1 point low teens, maybe 1.2. So I don't think it's in fair value range after that pop, but it's an interesting company for me anyway.
Nice. So, we have a few companies that we are wishing to also go to the American Stock Exchange, right? So let's see what the others will do.
Yeah.
Thanks. Look, these were, I think, 1, 2, 3, 4, 5, 6 companies that we discussed here today. So this, of course, like always, jam-packed. Next week, we still have a few earnings. You'll be in Las Vegas, but I'll make sure that when we record, we'll look into a few of those as well. We have also a guest coming up in the end of August. I'm also looking forward for that. But before we get there, we still have quite some questions. So maybe we can do kind of in the conscious of time, also a little bit of a fire round quickly that we go through some of them because otherwise we'll be talking still for another hour because our community, I can tell you, is very engaged. So let's start with Tiago under the title nowadays, Shade Research. Did you take advantage of the dip this week?
No, I did not.
Me neither. Good.
The dip was not long enough. Ex-Berliner, don't you think the upward and downward premiums are also irrational?
Yes, of course. Yeah. Answer is simply yes. How about you?
That was quick. I agree. Yes. Alan has asked about dividend tax, which is always a fun topic. You talk a lot about dividend tax. Which country would you like to invest but don't due to dividend tax? I guess Switzerland, Sweden, Finland. Does that also mean that you exclude companies that might give you a better return or a better yield after tax?
No, I invest in any company because I then look at the yield after tax. But of course, to be able, the accessibility then to a company in Switzerland, they need to trade at such a multiple that which is lower than usually in other countries. Actually, this is also the case in those. I notice often that in Europe, specifically the higher tax companies, often they trade at low ratios because I guess it's not interested for foreign investors. One other reason why we need this bloody withholding tax reclaim thing implemented in Europe so that we can all get this for 15%, because I think then much more money will flow into those countries. Really, that there will be. It will start with retail, but also the big ones, the big companies, if they can really save a lot of money on this, because don't forget, they also need to pay people for reclaiming their taxes. Yeah, so it would be good. But look, if there was any company, no, any country that I wouldn't like to live for the tax at the moment, it's actually the Netherlands. What they are doing there, it's crazy. I mean, soon there will be no incentive anymore there to work effectively. If you need to hand in almost everything back to the government, who redistributes it again. Yeah, I don't want to go into politics, but what the Netherlands is doing with the tax and also the taxation of our investment portfolios, it's just insane. It's really, really insane.
Yeah. Everyone has that same feeling about their own country at times.
Well, I don't have this in Poland. I don't have it in Poland.
Yeah. I would say Switzerland. Definitely Switzerland. That high 35% tax rate kills me. Yes, you can get companies that will give you a better return or better yield after tax. But I'm going to talk about a company like Roche Holding. It's a company I would love to own, but it only has a 3.4% dividend yield at the moment. So after tax, that is just too low for me. And it
Yeah.
takes me out of those types of companies. So yeah, Switzerland is one of those countries. And the Stocks King is talking about gold and silver. Do you hold any, and what do you think of this sector?
No, no, I don't hold anything and I don't need it.
Yeah, I don't. Why would you hold gold when Bitcoin is a store of value? That's what I want to know.
Well, we
Um,
have seen that on Monday, the store of value story from Bitcoin. No, but look for me, it's a lot about how much can I spend time on things. Yeah. So for me, if I want to have cash, I put it on the bank. Yeah.
yeah,
I have a house, which is also an inflation hedge. Yeah. But it has the risk of other things again, of a stock market collapse. So, there I don't think there is such thing as a store of value that gives me a guaranteed purchasing power. Yeah. But by having money in my house, by having money on the account, like let's say the emergency fund, by having money in the stock market and high quality businesses, I should do relatively better than others when shit hits the fan. Yeah, when
mm,
we're talking about the apocalypse. Yeah,
yeah, yeah. I, look, I think I can see the value investing in gold and silver, but it's more of a hedge with your portfolio. I'm all in on equities. The the question is like with online digital currencies coming and all this, will gold still hold its value? Everything is turning digital. So maybe physical products lose its value over time. And then if there is a war, maybe having gold is a good thing, but you
yeah,
might
but
not
then
be
you
able
need
to
to have the
access.
gold bars at home. Yeah,
Exactly,
then you need
exactly.
to have it in your hand, and even then, I don't know how safe you are during a war because if they know you have gold bars in your house,
Yeah, yeah, yeah. You're
yeah,
not going to use it to beat someone over the head with or something. But
yeah,
yeah, for me, it doesn't fit in with my investment strategy. I don't need to hedge. I'm still young enough. I feel that
yeah.
I can withstand the risk I'm taking with my.
If I wanted to hedge, I would go into bonds to provide discussion in my portfolio.
Yeah. Yedida. About a year ago, we recorded a podcast titled "Realty Income Under 60." Now it has finally climbed back above 60. What are your thoughts on it? Can't believe
Well,
that was a year ago.
yeah, high quality company. It has been growing its FFO quite nicely. So the company is doing everything right. I did start to like ADC, Agree Realty, more over the year once I realized that it's the little brother, but it has still those 20 years of growth ahead that Realty Income had already be is already passed because they need to make larger acquisitions. But yeah, it's a central holding in my portfolio, Realty Income, and it will continue to be if it continues to develop like this.
Yeah, yeah. I haven't done a renewed valuation on them. Actually, I think I did when I was looking at Agree Realty, but I can't remember off the top of my head. But I know around the 60 mark was still around fair value. Um, they pay monthly dividends. Who doesn't want monthly dividends? They posted themselves as that. But look, I think that the worry with them, as we said, is diversification. They're
Yeah.
getting so big that they're moving into areas that they might not be as comfortable with. So I think that's just something to keep an eye on. But at the moment, I think they've done quite well. I've liked the venture into Vegas. I've liked what they've done there. But look, you have to keep an eye on that. And Agree Realty is smaller, so it can focus a little bit more on the lane that it is well used to. So just
Yeah.
be aware of that. But I still like Realty Income. It's still a core holding in my portfolio. Tim has asked us about real estate investment trust exposure in your portfolio. What's the ideal exposure rate, and what do you plan to increase it to by age?
So generally, I don't want any sector above 20% in the long term. It may be there for a bit while I'm building a portfolio or something like that, but generally not more than 20%. Age doesn't matter for me. It's more about conviction of the sector. Why I like REITs, and I never had them really in the beginning because I had to understand it better. I just love it because, often I'm driving around to anything like, should I invest in an apartment here in Poland and just have it and then here? But you don't need it when you have proper REIT exposure because it's liquid. You can sell it at any moment in time. I probably get a better yield even. I don't need to deal with all the taxes and the renter, the tenants. So for me, it's really a nice opportunity that such thing exists, but not more than 20%, no matter what age.
Yeah, I think that's fair. Like 20%, over 20% is too high when you're getting close to retirement. But I think real estate is good for income. There's
Yeah,
always that
exactly.
argument that it doesn't outperform the market and all this, but I don't really care about that. It gives me
No, it's fair
consistent.
income. I've got Cibus, Defama, Realty Income, and Agri Realty. Some of them are clearly Cibus on the income, but then if you look at Defama, the opportunity for growth that it still has, so lower yield, but I'm very happy shareholder to grow with what management is doing there.
Viva dividend. On average, how much do you increase your dividend income per month?
I
Maybe
have no clue.
I would say 3 or 4% because that's around the dividend yield that I'm buying. Sometimes it's 6 or 7%. Yeah, but
Yeah.
I don't look at the average
Yeah,
price.
but for instance, if you have €1,000 in average dividend income, let's say, then when you buy something or when it is a dividend hike combined, it's like 1,030 after 1 month, 1,060 after 2 months, 1,090 after 3 months, and da da da. So 1,300, which is 30% growth
Yeah,
after a year. Yeah, I don't know, right? But it's a lot. Sounds like a lot.
it is a lot. It is too much. But look, like the average yield is probably between 3 and 6%. So it's somewhere like when I'm buying it per month. If I spend 1,000, I'm expecting to get 30 to 60 euro additional amount, or my forward paddy would
But
be.
are you're having annual yield on your portfolio, not a monthly yield?
Yeah, my annual
Yep.
yield, my portfolio yield is around 5.4%.
Yeah, exactly. So that means you have a monthly yield of 0.4% or something like that.
Yeah.
Just saying.
Maths is fun. Niels has asked us about, do you see dividend stocks hurting a lot in the coming months because of the carry trade problems? So
No, not really. And I know what Niels is talking about. He's talking about so maybe the carry trade. This is a trading strategy where investors borrow at a really low interest rate in one currency and invest in another asset denominated in another currency that provides a higher rate of return. Yeah. So you're really doing just like you're benefiting from the spread on interest rates here between two currencies. So you can buy something on a low interest Japanese yen to buy higher interest currencies. So I mean, again, this comes a bit more to the macro as well of what happened on Monday in Japan. But no, I don't think so. I mean, yeah, it can maybe lead to a sell-off in dividend stocks, but when I read, do you see dividend stocks hurt a lot? I don't think it will lead to dividend cuts. I think it will just to lead to better opportunities for us to buy dividend stocks. So yeah.
SBT92. Hi lads, what columns do you have set up in your interactive brokers account on your watch list or your own stock list?
Just out of the box. I do have the screener in the screener section where I add dividend yield and such, but other than that, I use the out of the box because honestly, I don't look at my interactive brokers account for the portfolio. I have it in my G sheet and my template. So
yeah. I have dividend yield, ex dividend dates, and profit and loss. I think that's all I have. Not much more exciting than that. JH Investments. Should there be any documents that I should download regularly from my brokers? I always wonder if one day a broker goes down and there's a problem with my username. How can I claim my stocks?
So I cannot answer this question because here you're talking quickly about legal aspects as well. So what is proof? Yeah. But what I do, not for that reason, but just in general to have my administration in order, I download of course, my annual report that I get and everything. And at that time, also to prepare the tax forms, I download all the transactions. So at least I have it on an annual basis. And then also mid-year, I usually make once a dump for my own calculations. So that's the information that I have. And for the rest, I trust the system, not in its entirety. But what I mean with that is like our holdings are at the, how do you call this, at the under custody or something like that, in a separate
Custodian account.
custodial account. So what I mean with that is like if the broker goes bust, the shares are still for us there. Will it easy to get access? Will you be able to make a screenshot, say those were mine? My experience is that those companies don't suddenly turn off their cloud support when a company goes bust. There comes in such a person appointed by the government who will deal with the whole thing. You saw this, for instance, also with this guy that got in jail from this cryptocurrency exchange, right? So still, it got locked. People got then were access again, as I understood. So I think the regulation is good enough there to protect us in this. Yeah, but otherwise you would need to download every transaction every time and make screenshots every day if you're afraid of that. Yeah, well, I've got better things to do.
Yeah, I
What
understand.
I do is I spread my accounts. Yeah, so I have a few brokers, not everything in one.
Yeah, I'm the same. I download all my annual any document that they put up there. I download it and
Yeah.
put it aside. Wicklow Wolf, what are your portfolio betters to the SPX?
I have no clue.
No, I don't either. I don't track it, so
No.
I don't know. Richard Taylor has asked about dual-listed Irish house builder Cairn Homes, ticker symbol CRN. He said it's a new player to the dividend world with 3 years of growth, 1.4 billion market cap, 65% 1 year capital growth, and a 3.5% yield. Do you know this company, and is it a possible future star for investors? Yes, I know the company. I did not know they were paying a dividend because the last time I looked at Irish companies was probably 4 or 5 years ago. So I wasn't aware they paid a dividend, but I wouldn't be too enthusiastic about this type of company. It's a house builder. So they build houses, apartments, and so on. Based in Europe, based in Ireland. I don't even think they build outside of Ireland. From the last I looked at them, so it's a small market, a small niche. Is that enough to continue growth to the dividend? Well, if you look at house prices in Ireland, maybe, but I still think back to the Celtic Tiger and then the financial crash and the housing market, and how the housing market is so intrinsically linked to people's investments over here and philosophy. And yeah, I'm not a fan of that sector, so I try and stay away. Yeah, that's about as much as I say. Is it a possible future star? I don't know. It's hard to say after only 3 years, but I think it's a very cyclical sector, so I would not be too enthusiastic to invest in those. David Abraham has asked us, first of all, welcome back, hopefully fully recharged. This was from last week. He was late with the question, but it was about Parker Hannifin Corporation, ticker symbol PH. Did you ever take a look or consider this company as a potential holding?
Yeah, I did one time look into it, but first of all, the dividend yield, if I'm correct, is just 1.2%. However, they have a 5-year CAGR of 14%. Company is a dividend king with 68 years of growth. So clearly, this is a company with a very strong moat, proven through the decades. So I've looked at it a bit, but for me, the yield is just already turning me off. Really simple like that. But the business seems to be very solid. They're specialized in motion and control technologies, so something you know a bit more about again. I think they just have a proper safe dividend as well. But yeah, no, not because of the yield. It's just not generating enough income for me.
Yeah. The 14% dividend CAGR is quite impressive. They have a low payout ratio as well, sub 30%. Free cash flow, 30% EPS, and a massive 77 dividend rating from us. So it clearly has a good company, has good qualities about it. It's the yield that will put you off. And you would imagine they have room to increase that more with payout ratios so low.
Yeah.
Looks like a company to keep on the back burner in case it ever dips. Bit like Spirax, I would say. Anders has asked us about the railroad industry. He'd love to hear our thoughts on it. It's a boring defensive play on an otherwise cyclical sector. Any thoughts?
Well, simply like that. I like this industry, but it's mostly in North America, and I'm still such a person that doesn't understand why North Americans don't take the train. Yeah, need to do everything by car, but then products are shipped by train. So as a European, I just don't understand it. I don't have any feeling for this business. I know Buffett likes it. I know many people like it therefore as well when they looked into it. Yeah, for some things you just don't have a feeling. I think it seems to be a solid business with proper mode, but yeah,
Yeah,
never enticed me to go deeper into it.
yeah, but if you look at it, it's not going out of business. It's needed in America and also Europe for different reasons, right? So it's a necessity, and you're not going to break into that business. There's no new railroads going to come in there, so you're quite safe. They have monopolies and duopolies. So from that point of view, I think it makes sense. Remember looking at Canadian National Railroad. I think the yield was quite low, or the valuation was high.
Mhm.
One or the other thing. I think the problem with me is the valuation is always high because of the moat that they have, that you can't easily break into that sector, and it's always turned me off them. But I could 100% see the appeal as a boring defensive play. I think it makes a lot of sense. Fragments of lightness and darkness. What do you think of Disney's earnings? I didn't really look at them.
Well, they were up by 4%, the revenues, and I think the operating income was up by 20%. So that's really good. It was mostly by a much better profit in their entertainment business, which is also their largest business. It's not a dividend stock anymore for me, so that's why I don't really pay attention to it. May this be a turnaround point? It may be, but I can't give any meaningful insight on that. I'm sorry.
Dara has asked me a question about taxes in Ireland. Has asked if I'd ever consider doing a write-up on them. Ireland is a small country, about 5 million people here. We cater to a European and American audience, and taxes is quite complex. So I don't imagine I will write something specific just for Ireland. But Dara, if you want to email me if you have questions, we can bounce ideas off it. I'm not an expert on everything tax related, but sometimes it's nice to just chat to other people and get an opinion. So yeah, feel free to hit me up and we can have a talk about it. El Cuba has asked us about our thoughts on Diageo. I think we mentioned this a couple of weeks ago. Struggling market. China again is struggling, which is impacting them, but valuation is still not there for me. They're still overvalued. They were richly valued to begin with, and I think they're starting to come down to a more reasonable valuation.
I'm here.
And the last question goes to Philippe. And it says, we often have discussed Unilever, but have you ever looked at an other UK company, iconic UK company, by the way, GSK? What do you think about it?
I've looked actually quite often at them because, it's one that pops up on the screen from time to time, but every time I don't want it. I find it not a high quality business. I find that, like how I thought about Unilever over the last 2 years. Over the last 2 years, I wouldn't have bought Unilever. Same I have now with GSK.
Yeah,
not a company I need to own.
Yeah, nice one. That's the last question. We said we'd rush through the questions at half an hour ago. It took us a half an hour, so we didn't do too badly. Thanks to everyone for all the questions. Some really good questions there. As always, we hope you like the show, and we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We're just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.